Well, heading into a week of packed earnings, the S&P currently trading at more than 20 times forward earnings estimates. That's according to Piper Sandler. But our next guest says valuation concerns, they're overhyped. Joining us now, we've got Michael Kantrowitz, Piper Sandler's chief investment strategist. Michael, it's great to have you on. So valuations, you're not worried?
I'm not concerned about valuations. I'd be concerned about macro catalysts that have historically consistently led to lower valuations, such as a sharp rise in interest rates, a sharp rise of inflation, or a sharp rise in the unemployment rate. If we think about where valuations are today, and we're trading nearly at 22 times forward 12-month earnings expectations, I think we're largely there because there's really little concern of those three macro variables that I just mentioned.
So I guess when you take into account the biggest driving force here of some of these sustainable returns that we have seen within the market, how much of that has to do with earnings and how much emphasis should investors be placing here over the next several weeks and then, of course, looking ahead to 2025?
Well, I think when you look at, markets broadly are up this year. And a lot of that has to do with multiple expansion and how we came into the year worried about a Fed that may still hike or inflation that may return or an economy that may go into recession. And so as we sit here in late October, those three fears have abated. So that's, I'd say, been the predominant driver of equities. And then when you look at leadership within equities, in other words, what is outperforming and what is underperforming, that's largely explained by earnings. S&P 500 earnings estimates have increased about 9% from where they started this year, whereas small cap earnings, for example, are actually below where estimates began the year.
It's interesting because the kind of zombies that you mentioned, you say, Michael, we're going to be fine as long as these three huge potential bearish events don't happen. I didn't read that as encouraging when I was reading it as you just said it. What would you say to investors who take those three potential risks as something that they should really be hedging against?
Yeah, well, I mean, right here we're sitting at with a 10-year bond yield back up to about 4.15 from a low of about 3.6 not too long ago. And again, it hasn't really impacted the markets negatively, but it certainly has shown up in areas of leadership. A lot of the best performing groups in the third quarter that did well as interest rates declined are not outperforming this quarter. So, the broad consensus for the market today and the economy is clearly a soft landing, a lot of rate cuts, and pretty good earnings growth next year. So I think things would have to deteriorate pretty sharply, or the 10-year yield would probably have to get near about 4.5% for investors to start really worrying about higher interest rates and start extrapolating those. So I think as we sit here today and going to the end of the year, I think PEs are going to remain high. But as we go into 2025, certainly if we start to see the economy broadly reaccelerate, I think it's going to be an issue for multiples as I think fears around inflation, interest rates, and how much or how little the Fed will cut come into view.
Michael, I'm curious just to get your perspective, and I know it's a competitor, a different house that has this prediction out, but T. Rowe Price was talking about the risk here that we could see 10-year yields hitting 5%. How realistic are those concerns, do you think, at this point?
I don't think it's a risk in the near term, but certainly if the unemployment rate starts or continues to trend down, and we've had 2 months of unemployment ticking a little lower, that I think will can create some concern. I think the markets are pricing in if a Trump presidency comes to pass, that also is bearish for interest rates. So 5% is a ways from where we are today, and I think it would certainly change the narrative around Fed rate cuts. I don't see the Fed cutting if we're at a backdrop with the 10 years at 5%. So it's kind of a double negative if that does come to pass.
All right, Michael Kantrowitz, always great to have you. Thanks so much for taking the time to join us here. Piper Sandler's chief investment strategist.
All right, bye-bye.